New reporting from senior economics reporter Steve Leisman on where the Fed really stands on tapering. More importantly, when it could actually start and how. Steve, this is a big deal. It's the question that everybody needs to know. When is the Fed going to start to pull back the support for the economy, and how is it going to message that to the market?
Yeah, you're going to have to relax a little bit on this, Scott, as is the market, because the Fed is in the early stages, we found, of a campaign to ready markets for reducing the $120 billion in monthly assets. The Fed looks likely to discuss tapering as soon as the upcoming meeting in June, and depending on how the economy comes out, could be on track to taper later this year or early next year. At least 5 Fed officials have been publicly commenting on this. They didn't before, on the likelihood, by the way, of those discussions in recent weeks, including Patrick Harker of Philadelphia, Robert Kaplan of Dallas, Fed Vice Chair Randy Quarles, and importantly, after the jobs report, Loretta Mester of Cleveland. She made those comments right here on CNBC. So what's the timeline look like? An announcement of a decision to actually taper would be several months later, perhaps in the later early fall. Fed would announce a taper. December, January is when the Fed would actually begin to taper early next year. Behind the glacial pace, importantly here, of reducing these asset purchases, a deliberate attempt to avoid a taper tantrum by making it clear to markets. Taper is on a different time path, Scott, and has different criteria from raising interest rates.
It's not by accident, in other words, Steve, that you've now had those 5 speakers come out and start to lay the groundwork. This is the calculated strategy by the Fed to avoid another taper tantrum and the mistakes that were made the last time around.
Exactly. Just loosening the reins a very little bit to say they're telling us they're going to talk about it. And then they're going to talk about it. And then they're going to make a decision that they're going to do it sometime down the road. And all of that, Scott, you have this very long runway. And because the market, I think, is well convinced that tapering is different from raising rates and that raising rates comes after tapering, that at least gives the Fed this 8 to 9 month breathing room until the tapering starts before it has to worry about or think about pricing in higher interest rates. And looking at the 10-year, looking at the 2-year, looking at Fed funds probabilities, it looks like at the moment the market is giving the Fed that leeway for this kind of glacial timeline.
Yeah, giving it the benefit of the doubt, at least thus far. Steve, you're going to stay with me. I'm going to bring in the committee and kick this around a bit because it is the central question. And Joe, you know, how does this sound to you the way Steve has just laid this out? A snail's pace, a deliberate pace, all ultimately getting to the point where the Fed starts to pull back, but not for a while.
It sounds very smart. It sounds as if they're going back to 2018 and understanding when you pull back liquidity and economic growth begins to contract as it did during that period because of the tariffs, you're going to create fiscal tightening and you're going to create a problem for the markets. I wonder how much of the monetary policy that we're currently being benefited right now with risk assets is waiting to see what's going to happen with fiscal policy, Scott. Are we going to sit and wait and understand if tightening is going to come from higher taxes? What exactly will the fiscal policy over the next 3 to 6 months do to the economic growth? I think that's incredibly important. I think monetary policymakers are being smart to wait and see the result there.
The other deal, Steve, is that you're not actually going to get an actual taper until December or January. That's very interesting in terms of, you know, your reporting and the way you understand the way that the Fed is currently thinking. You'll get communication long before that, but you're not going to get a taper. I was wondering whether we were going to get tapering in the summer, and that doesn't appear to be the case according to your understanding.
Only those shorts of yours, Scott, or perhaps that Hawaiian shirt would get a taper, I guess. But listen, Joe has it right. I think what he said is very important because the Fed is going to wait to see the outcomes of fiscal policy before adjusting its own policy. It is not going to preemptively think about, well, fiscal policy is going to do X, Y, and Z. So Joe has that exactly right. And Scott, look, let's be clear. This is outcome-based guidance that we're getting from the Federal Reserve, and they have yet to do what they're going to have to do, which is to convert outcome-based guidance into calendar guidance. So that's sort of the next step they're going to take, is they're going to go from okay, if this happens in the economy, then we're going to do this soon enough. Maybe as soon as this summer, maybe as soon as early fall, they start to put dates on these issues.
Yeah, and Bryn, an important thing is going to be that the way the Fed communicates this, something that, frankly, and I think Steve would admit this too, it hasn't always done that in the best way it possibly could. It's going to have to really get it right this time around, Bryn, right?
Well, yeah, absolutely. The Fed has over 750 PhDs, but that really doesn't teach you how to communicate effectively. A bunch of smart people. I think that, Steve at the onset said three important words about the market, that at the moment, the market is going along with the Fed in terms of their outcome-based trajectory. My concern is, though, the longer this goes, although it's wonderful, we want to see equities and risk assets continue to inflate, at what point does the market start disagreeing with the Fed's trajectory and start pricing in an alternative outcome? Because, as I've said before, there is no playbook for between the pandemic, the monetary and fiscal stimulus that is upon us right now. And so I think, as investors, you have to be nimble, heavily diversified. But I think that this is, a needle in a haystack for the Fed. And I think not only the communication, but I think when they start doing it, how the market reacts to that, to me, is what's most important.